My name is Roderick C. Dix, financial advisor and founder of the Goods Virtual World. Welcome back to Good Wealth. In the last module, we built the foundation. We understood the client. We understood suitability. Now we move into the tools. Because once you understand the person, you need to understand what you are actually recommending. This module is about investment companies, and more importantly, how capital is structured, priced, and distributed inside those vehicles. Let's start simple. An investment company is an entity that pools capital from multiple investors and allocates that capital across a portfolio of securities. Write this down. An investment company pools capital and distributes risk. Under the Investment Company Act of 1940, there are three primary types you must understand: mutual funds, unit investment trusts, variable contracts. We begin with mutual funds. A mutual fund is an open-end investment company. That word matters. Open-end. It means the fund continuously issues and redeems shares. Pause and think. If investors are constantly buying and selling, what must the fund calculate every day? Its price. This brings us to NAV, net asset value. Write this down. NAV equals total assets minus liabilities divided by shares outstanding. This is the price investors transact at. Now here is where precision matters. Mutual funds are priced once per day, at the end of the trading day. This is called forward pricing. Pause and think. If an investor places an order at 10 a.m., do they receive the 10 a.m. price? No. They receive the next calculated NAV. That is a common exam trap. Now let's apply it. An investor places a mutual fund order at 2 p.m. At what price will the transaction occur? A. The price at 2 p.m. B. The previous day's closing price. C. The next calculated NAV. D. An average of intraday prices. The correct answer is C, because all mutual fund trades are executed at the next NAV under forward pricing. Now we go deeper into structure. Mutual funds offer different share classes: Class A, Class B, Class C. Each one represents a different way of structuring cost. Let's start with Class A. Class A shares have a front-end load. This means a portion of the capital is deducted at the time of purchase. Real example. An investor allocates $10,000. There is a 5% front-end load. How much capital is actually invested? $9,500. Write this down. Front-end loads reduce invested capital at entry. Now we elevate. Class A shares are the institutional choice because they offer breakpoints. Breakpoints are volume discounts. The more capital you commit, the lower your sales charge becomes. Write this down. Breakpoints reduce sales charges as investment size increases. This is why high net worth investors often use Class A shares. Now Class B shares. These do not have a front-end load, but they have a contingent deferred sales charge. This means if you exit early, you pay a fee. Write this down. Class B shares penalize early redemption. Now Class C shares. These typically have no front-end load, but they carry higher ongoing expenses, which means over time, they can become more expensive. Write this down. Class C shares prioritize short-term flexibility but increase long-term cost. Now we connect this to suitability. The correct share class is determined by time horizon. Long-term investors benefit from lower ongoing costs. Short-term investors benefit from lower entry barriers. Now let's move to 12b-1 fees. These are ongoing distribution and marketing fees. They are deducted from the fund's assets, which means the investor pays them indirectly. Write this down. 12b-1 fees reduce long-term portfolio performance. Now we move to unit investment trusts. UITs are structurally different. They are fixed portfolios. Once created, they do not change. Pause and think. If there is no change in the portfolio, what is eliminated? Active management. Write this down. UITs are unmanaged and fixed. They also have a defined termination date, which means they are not permanent investments. Now we move to variable contracts. This includes variable annuities and variable life insurance. These introduce market exposure. The investor selects sub-accounts, which function like mutual funds. Now we elevate the language. In a variable contract, your capital is held in a separate account. This account is distinct from the insurance company's general assets. This is where your market exposure exists. Write this down. Separate accounts isolate investor capital and transfer market risk to the investor. That distinction matters. Because if the market declines, the client bears the loss. Now we connect everything. Mutual funds provide diversification and active management. UITs provide structure and predictability. Variable contracts provide market exposure through separate accounts. Now we elevate the thinking. You are not asking, what is this product? You are asking, how does this structure affect cost, risk, liquidity, and outcome? Now real-world application. A client wants growth, but cannot tolerate volatility. Ask yourself, is a variable product appropriate? No, because the risk is transferred to the client. That violates suitability. Now let's test your understanding. An investor wants a professionally managed portfolio with continuous adjustments. Which investment is most appropriate? A. UIT, B. Mutual fund, C. Fixed annuity, D. Treasury bond. The correct answer is B, because mutual funds provide ongoing management. Now another. An investor plans to invest a large amount of capital long-term and wants to minimize total costs. Which share class is most appropriate? A. Class A, B. Class B, C. Class C, D. UIT. The correct answer is A, because breakpoints reduce the upfront sales charge and long-term holding minimizes overall cost. Now step back. Every decision in this system is a trade-off. Cost versus time, risk versus return, liquidity versus growth. Write this down. Every investment decision is a structured trade-off. Now final lock. Mutual funds are open-end and priced daily. NAV determines pricing. Forward pricing governs execution. Class A includes front-end loads and breakpoints. Class B includes deferred sales charges. Class C includes higher ongoing expenses. UITs are fixed and unmanaged. Variable contracts use separate accounts. 12b1 fees reduce performance. Time horizon determines share class suitability. If you understand this at this level, you will not just recognize the correct answer, you will eliminate incorrect answers instantly. And that is how you move from preparation to mastery. You just got the goods from the goods.